Questions? Also, you have to give up the regular seats to the paying customers, the people who belong in the class. All right, today we're going to do Liz Clairborne. This is your second valuation. How do you want me to start? What would you do? We pick the stock. Somebody gives you a stock. I'm an extremely badly behaved but well-known portfolio manager of dubious performance. And I give you a stock to look at, and it's Liz Clairborne. What's the first thing you're going to ask yourself? Yes. Yeah, what does the company do? And the second thing you're going to say is this guy wasting my time? What does the company do? They're in the rag trade. Used to be that Ben Graham had a dictum: buy value and never in the rag trade. How could you tell if the person is wasting your time? I mean, what kind of an idea would you like? Ugly? Obscure? Disappointing? If we were doing this as of year-end 2000, there are 109 million shares outstanding at $40 a share. So the equity is worth $4.36 billion and the debt is $540 million. It's worth almost $5 billion. Over the prior 3 years, it's returned 18% a year. Over the prior 5 years, it's returned about 15.5% a year. Does that sound like obscure and disappointing? I want to ask the women here, how many people have not heard of Liz Clairborne? I think every woman on Wall Street owes some Liz Clairborne clothing, right? That's why they used to love Ann Taylor. We used to do a retail exercise, and no matter what ridiculous price Ann Taylor was trading at, all the people who loved to shop at Ann Taylor would decide that Ann Taylor was a great value investment. So it's not obscure, it's not small, it's actually not bad on the cheap front for this market. It's selling at 14 times earnings and 2.4 to 2.5 times book. But that's where you want to start. Now, there is something else you also want to look at. Are there recent problems with this stock? Is there anything that would have, around this time, have led people to say, I don't know, I'm dumping this one? And how would you look for problems? I mean, if you were going to be tempted to buy Coca-Cola because you think it has a good return, what sort of things would you like to see out there about Coca-Cola? You go to Business Week, and what kind of story would you like to see? Coca-Cola is dead. Coca-Cola is last year's history. Those are the stories you want to see, that they're screwed up, they don't know what they're doing, Pepsi is eating their shorts. Is there any indication that that's going on here when you read the annual report? Does the chairman sort of have to explain away a lot of embarrassing things? Does he talk about next year? No, he doesn't. These guys are pretty much on a roll. So the first thing is that when somebody hands this to you, you're going to be real surprised if this is a bargain. And if it does look like a substantial bargain, you're probably going to look at it again, because there's just no obvious reason why this stock should be a bargain. I mean, people are not down on clothing. This is not newspapers or another dying industry. There's not bad management here. The head of this company, it's Paul Sharon, or Karen, how does he pronounce it? Sharon. Paul Sharon is a widely admired figure in the industry. So you probably decide this is a waste of time, but still, you'd go ahead and do it. Well, what are you going to start with? Anybody? The balance sheet. First, you just want to see if you went ahead and bought it, what would you get after the intangibles? Now, I get $393 million in cash, and it does seem to add up to 1509, which is what current assets are. Is that approximately right for cash and securities? Because Aaron has a slightly different number. Okay. So I got 393 in cash, reproduction value 393. I got 4032 in receivables. Do they actually identify an allowance for doubtful accounts? No, they don't in this case. You can make an adjustment, but if, yeah, sorry. Oh, they do? What is it? Where is it buried? I couldn't find it. Okay. So what is it? Okay, so you could add back 43 million to that if you're looking at replacement value. And it might make a little bit of a difference. So I couldn't find it. Sorry about that. By the way, 43 million is much higher than I would have expected. And it's probably, you know, again, every time I decide you're going to trust these guys. So I said, you can't find it, but it won't be that bad. It means if they're hiding it from you, it's probably not good news at all. And I guess that's true in this case, right? Because I've never had trouble finding it before. Go ahead, yes. Well, but if it's a write-down from receivables, it's money that they booked as being owed to them by their customers that they're never going to collect, right? So that's not a happy. No, yes, probably that's for 1 year. Don't forget, I don't know how long their accounts are out there for, but sometimes they may be out there for a while. I mean, you'd like to think they're all the receivables are under a year in duration, or they've really been written off, but you never know with these guys. So the income, no, I deliberately didn't look at the income statement number off sales. But anyway, you probably could do some adjustment. Does it make a lot of difference here, just as a starting point? But I'm sorry, your name again is? David. David will remember and come back at the end, and if the 42 million makes a big difference, we'll do the adjustment. Then you've got long-term, you've got inventory. They already do it on a FIFO basis, so you don't have to do a LIFO to FIFO adjustment if you're doing reproduction costs. And deferred taxes and other current are probably not much worth bothering about. So you've got about $1.5 billion of current assets that you're getting with the company. It could be 1.55 billion. It's going to be relatively close to book value. If you're in a hurry, don't do any real adjustments on this end of it. If you have to go back, if it makes a big difference, do it. Then you've got property, which has an original cost of 140 million. Do you know where that property is? Anybody? Yes. Right, it's in, the big property is in the Meadowlands, just over the tunnel. That property has actually done pretty well. So even though I've multiplied it by 1.5, that property could be worth 300 million or so. So again, if that's a crucial thing, you probably want to look at that in considerable detail. Where can you find where the property is? How did you? Exactly. They'll list it in the 10K. They'll tell you where this property is. And if you're buying this on a property play, you locate where it is. If it looks like it's gone up a lot recently, i.e. if it was in New York City, you would, or northern New Jersey, you would go out and value it. Then I've got machinery and furnishings. They have an original cost of $537. What are you going to do here? It's probably hard to figure it out. Where are they getting most of their clothing from, by the way? Do they make it themselves? No, they don't. This is design equipment. These are trucks. These are things like that. Machinery, by and large, has become cheaper. If you think these trucks are on average 4 years old, Truck prices are actually down about 2% a year for the same volume to flat. You're not going to write it down. You got some wear and tear, so you might write it down by 7% a year or so. It's not going to be a big deal. I took 60% again. What we're doing is what you can do in class when you first do it. Anytime you're doing a careless job of valuation here, put an asterisk by it, and if it's important at the end, go back and look at it. For various reasons, you're going to see we're not going to waste a lot of time on this because the one big asset, which is the brands, is where you want to spend your time. I took 60% of original cost. I did a little model with the decline in wear and tear on the machinery, with the declining prices of machines for replacement costs, looked at the average age, or what it looked I took to be the average age. Could take 50 if you don't even want to bother with that. Leasehold improvements, I assume, have a longer life, and actually leasehold improvements, since its construction, has not experienced the same productivity growth as making machinery. That actually construction productivity growth has been lower, so the reproduction cost of those leasehold improvements is going to be closer to original cost. So I took 70% there. Again, don't anybody ask me, are those the numbers to use? Because the answer is you can use almost anything that's reasonable. Anything between sort of a half and one in this case. But again, you have to understand that you're just making a first guess. And if it's important to know what the real number is, you'll go out and have to look at it. Other long-term assets are about $9 million. You want to take, remember, we're comparing enterprise value to asset value. We don't want to subtract the debt. We want to take off the goodwill and the intangibles. Why? Because those are a big number, and we want to think about them directly. What are the intangibles? It's the brand names, it's the store positioning, it's the purchasing organization and the connections with the reliable people who make this stuff, and you'd like to think about what the cost of reproducing that is directly. So I took the $1,037,000,000 in intangibles off. I got a net asset value of about $2.3 billion. I think anything up to 2.5 without the intangibles is reasonable. You could, if you did an accurate job on the real estate, even get a number conceivably higher than that. Are there any questions, though, about this as a first cut? So I sat down, I went over this all quickly. I subtracted the full value of the non-debt liabilities. The net tangible asset reproduction value of the assets is probably somewhere between 1.5 and maybe 1.8 billion. That's probably the range of error that we're looking at here. And again, if that difference gets to be critical, you will have to look in detail at those items. Well, what's the big asset that I left out? It's the brands. So the overall asset value, if I can get it here, is those net tangible assets plus the value of the brands. Now, increasingly, assets of companies are intangible. And you're going to have to, if you want to supplement your earnings power value estimate, you're going to have to go out intangibles. I'm going to start with what is the crudest, not the crudest way to do it, but one way you can do it. And that is ask an expert. First thing, that the expert said is, he said, look, when you look at a business plan for developing a new brand, and you look at the upfront costs compared to the peak revenues, the upfront costs are usually about 20 to 40% of the peak revenue, of the basic revenues once the brand is sort of fully launched. How did he know that? he had presumably done a lot of business plans. Now, the upfront costs include losses that you were going to incur while you're selling levels of the brand that are just too low to cover the fixed cost of advertising and promotion and so on. So if you added up the front-end negative cash flows of a brand development business plan, has anybody actually done that in a clothing company? Anybody here work as a financial analyst for a clothing manufacturer or similar? If you haven't, you got to talk to somebody who has, who's seen but these numbers have to be around. Because when they think about launching new brands, there presumably is a business plan that justifies that investment, and somebody has to be putting reasonably reliable numbers into it. By the way, the cost numbers typically in a business plan like that tend to be much more reliable than the back-end revenue numbers. And the first element of reliability is that the business plan always assumes that the brand is going to succeed, that you're not going to sink it later, that it's not just not going to sell. In practice, and this is quite a high number for new product introductions, only between 1/3 and 1/2 of new brand launches actually succeed. That is, they actually finally reach break even and generate sales even close to what they were supposed to generate. So that I'm paying on average about 30 cents per dollar of sales to develop a successful brand. It works between 1/2 and 1/3 the time. So at a minimum, in expected value terms, I'm paying somewhere between 40 cents if it was cheap to develop and the success rate is high, and $1.20 if it's expensive to develop and the success rate is low for the brand. It's about 80 cents per dollar of sales. Now, actually, that's not an unreasonable number. If it was much lower than that, what would typically be true of most clothing brands? They'd all make money, and people would find it really worthwhile to launch clothing brands like crazy, and we'd each have our own brand. So there is some basic reasonableness to that number. It looked, when the first time I showed it to somebody, he said, "Oh, that looks really high." But when you consider what the margins are and what the discounted value of that marginal contribution over the life of the brand, this number is probably not unreasonable. Well, on the other hand, new brands are not like the Liz Clairborne brands. In fact, as you read about the Liz Clairborne brands, the ones that they feature are all the new ones that they bought like Lucky. What's true of most of their brands? They're for older, staid, respectable people. Dana Buckman, what are some of the others? Ellen Tracy. You guys will grow into that, but there aren't a lot of teenagers buying Ellen Tracy, right? So he said, look, I think I have to discount these brands by at least 25% compared to a new brand. So the brand value he gave me was about 60 cents per dollar of sales. Now, that is a cost of development. It's a cost of reproducing similar brands. It is not at all based, one hopes, on the earnings of those brands. You want an independent observation. Because we're doing the asset value, we hope that the earnings power will confirm our asset value calculation, but we have no assurance of that. Any questions about who you'd go to for this? Because I think that's the important thing. Yes? Right. Oh, because, look, what I would get for my 80-cent reproduction cost is a new brand. Our brands are like machines that have deteriorated. So actually, I mean, and nobody tries, by the way, to produce, there's not a big market for de novo producing 3-year-old trucks. But the replacement cost of 3-year-old trucks is, in a sense, below the replacement cost of new trucks, right?
I mean, for a brand, though, you're saying that an old brand was less used. Would it be opposite? That was the previous.
No, remember, what we're doing is we're saying for a brand that is established, the expected cost of developing it to the point where it's established is about 80 cents per dollar of sales. But we've got brands that were established, so they're trucks that have been built but have worn out some. Do you want to write up or write down the value of the worn out trucks? I think you want to write it down. So now he may have just not really looked at well-established brands here. He may be thinking of something else. And one of the things we're going to do is actually next look at private market values, which is what they pay for brands. And I'll come back to you when we look at those. Because it does say, you'll see the prices they pay say something about that. But what you're talking about now is a net value for the Liz Clairborne brands by this measure of about 60 cents per dollar of sales. What's the next thing I want to look at to see if these are reasonable? I want to look at what Liz Clairborne has been paying for brands to see if it tells a similar story. If Liz Clairborne is buying brands for 10 cents per dollar of sales, what does it suggest about this number? It's much too high. On the other hand, if Liz Clairborne is paying 80 cents to $1 for brands, and they're relatively younger brands, what does that say about this number? It's pretty good. If Liz Clairborne is paying $5 per brand of sales, unless there's something very different about the brands they're buying from the old Liz Clairborne brands, then that's also going to call into question this number on that it's too low. So next, what we're going to do is look at some Liz Clairborne brand acquisitions. And you have the record of acquisitions. They stopped publishing in the later annual reports what the actual size of what they were buying was. They didn't make it easy for you to tell, but in the older annual reports, and I think I gave you the sales numbers. So they bought a brand called Laundry, I think in about 1998, 99. They paid $43 million. It was a range that would vary with the performance. They got about $1.1 million, $1.2 million in other assets. So they paid about $42 million for the brand. And it had $76 million in sales. So in that case, they paid 55 cents per dollar of sales. That is the first number that's reassuring. Now, I have one question. What about inflation? This was way back in 99. Do I have to take that into account? No, because I'm dealing with nominal sales then for the nominal price of the brand then. And you'd think that both the value of the brand and the cost of reproducing it has gone up, so the ratio ought to be similar. Then they bought something called Lucky Jeans. They paid for 85% of the company $185 million plus a contingent payment that was going to average $30 million. Actually, the contingent payment was 3 years out, so you have to discount that $30 million. I did it for 3 years at 10% and got about $19 million. So they paid, I take it back, I got $23 million. So they paid $108 million, which is the 85 plus an expected present value for the subsequent payment of $23 million. And they paid that for 85% of the company. That meant they put a value on the company of $127 million. There were non-brand assets that they bought with that company that were about $8 million. That gives you a brand value of about $119 million, and they bought $60 million in sales. That's close to $2 per brand. How about that? Does anybody know anything about Lucky Jeans in those days? Are you all, how old were you in 1999? I mean, my idea of fashion in 1999 was Sears Roebuck, but I'm hoping people in this room are a little more astute than that. I am told, sorry, go ahead. It's a younger demographic. It's a hot product that's growing extraordinarily rapidly at the time they buy it. And if you look at their annual reports at the time, the thing they've got pictures of all over the place is Lucky Jeans. So even though the current sales are 60 million, the projected sales are much higher than that. But still, this is at probably a slightly higher range. And what are you going to do with this information? You might think of shading up your brand value a little bit. Then they bought Sigrid Olsen, which is a new version of the older Liz Claiborne brands. It's the one that's most similar, except it was recently developed. They paid $55 million for 87.5% of the company. That's $63 million. They got $13 million in net other assets, so they paid $50 million for the brand. Again, it had about $60 million in sales. They paid about 83 cents. Is that reassuring? That's close to what our expert told us a new brand cost to develop. So actually, we've got two observations that more or less are in the range of what we were using. We've got one private market value that's slightly higher. What do you want to use as brand values here? Well, if you want to shade up the 60 cents, you could shade it up to 75. But it's probably not all that far off. Certainly, it's not lower than 60 cents, we don't think, the cost of reproducing comparable brands. It may be slightly higher, but who knows? Now, in your report, there are also other acquisitions. And here, this is going to be more problematical. But I might as well do it anyway. This is Ellen Tracy. I tried to read from the annual reports what the sales were. What would you do if you wanted to know what they were paying for here? You basically call somebody up and say, what was Ellen Tracy? How much in sales were? Or if you thought there was some other metric that was appropriate. It seems to me the power of a brand is sort of captured in the sales to begin with. Well, they bought Mex Canada and Ellen Tracy for $220 million. The estimated sales were about $240. That was the best I could do. I don't know, did anybody actually make a call to see how much in sales they were there? If you're thinking of buying Liz Claiborne, and actually at the end of this you won't be, you could make that call. But that gives you a value of about 90 cents. And then you've got Juicy Couture. Does anybody know anything about that? That's all these 12-year-old girls walking around with pants that say Juicy on their butts and shirts that say Juicy on their just developing chests. It's the hottest thing going. And what's interesting about that is it's very similar in price to what you saw for Lucky Jeans. And that gives you a sense that there really are two kinds of brands that are being bought here. There are hot younger brands that look like they command about $2 per dollar of sales, and there are these older brands that are coming in somewhere around maybe 70 cents, 75 cents per brand. Predominantly, where are Liz Claiborne's sales? In the second thing. So we're going to use, what I finally used was 75 cents because I had higher numbers from the private market values. I had lower numbers from the reproduction, the direct reproduction value. So in doing the asset value for the brands, you probably want to use a range. So you start with the tangible assets. Now here, because if you're not careful, you're going to wind up double counting. They own stores and they own brands. The stores don't have brand value. We're going to talk about the stores in a second. But actually, if you look at the segment revenues, it looks like if you can subtract off the 1066 in retail, and it's about 3.6 billion in actual branded sales. What's the comp? Sorry, go ahead. Yes. No, I'm not assuming. I'm trying to get at the value of the brands. And the value of the brands is sort of the wholesale price. Now, I may be understating a little because there's a retail markup, but I'm going to talk later about the value of their retail outlets. But I'm assuming their sales would be what they would be, but I don't want to impute brand values to retail sales that they're doing, to their retail division, right? Unless you think that there's a brand in retail, and we'll talk about that in a second. Go ahead. Right. Right, but when we valued these brands, when you bought Lucky and else, were they reporting sales at retail or sales at, what were they reporting? It had to be wholesale because it's the reported sales for, and they don't have stores. So all these private market values are per dollar of brands wholesale. When my expert talked about building a brand, since most Liz Clairborne stuff is not sold in in the stores that they bought, is he talking about a wholesale or a retail value? He's talking about a wholesale value. So I don't want to include the extra store revenue because that's going to artificially inflate the value of the brands here. Okay, so let's just do it on the wholesale value of the branded products. On the other hand, and that's about 3.6 billion, at 75 cents, that gives you a brand value of 5 million, or a total asset value of about 4.3 billion. If it's only 60 cents, it's 3.8 billion. If it's as high as 90 cents, it's about 4.9 billion. For that, you're getting a value, I think, that's about 4.5 billion. So on an asset value basis, do you think that this business is overvalued? Undervalued, rather. Probably not. It's trading at 4.9 billion. In this range with the brand values of 4 to 5 billion, say 4.5 billion. Maybe a little less than that. Are there any questions about how we've done the asset value? Because, of course, we've left out one important element to the asset value, right? Which is store traffic is something that takes a while to build and might be worth something. Anybody know anything about building store traffic? Anybody? We actually had a kid do research on this. And you want to pay attention to it when you value your retail. If the store is in a mall, how long does it take to build up to the mature level of traffic in the store? A couple of months. In a mall, the mall builds the traffic and you pay it in the rent. And we saw that by getting all the limited's experience of traffic build in their stores. And for the mall stores, the traffic build is essentially instantaneous. For standalone stores, it depends on the category. For some categories, it can be as long as 3 years, a year and a half. But it's much smaller than you'd think. And for mall-based stores, and I think there's very little value there. It's all discounted in the rent because it's the mall that builds the traffic, actually. So when you're doing value for retail, you do want to know what those figures are like. And the way we got some of them is obviously we got them from the limited. The other information we got, there are some companies that actually report because they report what the build is. So some of the wholesale clubs actually report the sequence of patterns for the build. For dress stores also, even on the standalone basis or a strip mall basis, turns out the build is surprisingly quick. You find out within a year where your sales are going to be. We have dress barn data, too, for that. Are there any questions about that? Presumably, it's something you want to know about. But the evidence seems to indicate here that the retail build, as opposed to the leasehold improvements in the stores or the value of the leases in the stores, has almost no asset value. It's very quickly reproduced and relatively easily reproduced. All right, can I ask how many people got asset values around here? Is all of this foreign to you? Nobody? Oh, good, Jenny. I'm happy with one of you. But what do I, oh, good, okay. You're just afraid. I'm not going to beat you up for getting the right answer. But I hope you have a sense of what you want to go through to value this company. And notice I have not looked yet at a single earnings number. This is an independent asset-based valuation, because I want to look at the value of this company from as many perspectives as possible, and it's going to turn out that is a useful thing to do. So I've got an asset value. What do I want to look at next? Yes, sorry, go ahead. Oh, yeah, yes, no. Well, then, if it's not a viable business, if we thought business, how would you value the assets? Liquidation. So what would be the value of the brands in liquidation? Probably close to zero. You might be able to sell some. Oh, the first qualitative judgment you make is this business economically viable or not? Is this business going to be around in 10 years? And I think the answer with Liz Clairborne is yes. By the way, has anybody looked at has anybody in their real lives looked at General Motors? Is that business going to be around in 10 years? Yes. Anybody know what the approximate asset value of General Motors looks like? Close to zero. Actually, when you subtract any reasonable estimate of the pension liabilities and you add back intangibles like the dealer network, like the product portfolio and things like that, it still looks like, actually, if you go through the balance sheet, the entire value of the auto company on the balance sheet consists of tax loss carryforwards. When you then do the adjustments for greater liabilities and greater assets and write down the tax loss carryforwards, you get an asset value that's close to zero. If you looked at the last 3 years of earnings power from the auto company, what do you think the value is you get for earnings? It's $124 million a year pre-tax. After tax, on that $195 billion of sales, it looks like the earnings power is about $80 million. So General Motors, you also get a pretty good picture. You get a picture of what the assets are worth going forward, and it's close to zero. And you get a picture of the earnings power, and that's close to zero too. So it's worth doing. Even if it's a continuing business, you can get a picture that says zero on both. And it's a reassuring picture. Well, what do I want to do next after I've done the asset value to get a feel for this one? I want to look at the earnings power value. Now, I'm not going to bother. They have small accounting adjustments. I'm not going to waste your time by averaging them out and going out for more than 3 years. There are small, actually take there's a relatively big one-time charge in the most recent year. I'm going to actually average it out when I look at the margins after the one-time charge. For the history up to 2003, you'll see EBIT margins that average about 10.5%, a little under 10.5%. If you then actually looked at what you'd forecast for EBIT for 2004, it'd be certainly something below 11.1, maybe between 10.5 because reversion to the mean is slow and 11.1. It was actually 10.9. So what might you use as a sustainable EBIT margin in terms of that history? I think you'd use something very much like that. If you look at net margins, because taxes are low in 2004, it's actually a little, if you look at return on equity, it's a little bit below where it's been in the past. If you look at EBITDA margins, which are what are reported by Value Line, so you can get a fairly long history on the cheap, you see that it's sort of the average of the last 3 years. It's right on that average. That's how I feel about General Motors, too. Well, if the last 3 years is a good estimate of sustainable earnings, and when you go back it's not so different than the past, you're probably using a 10.5% EBIT margin. You've now averaged out the effects of fluctuations, you've averaged out the effect of particularly good or bad years, and you've averaged out the effect of any accounting adjustment average over a number of years. So I got an EBIT margin of about 10.5 as a good average starting point for sustainable earnings. Now, whether they're truly sustainable, we believe, and to which they're supported by assets or competitive enjoys. But just in terms of mechanically computing what seems on a statistical basis to be sustainable earnings, about a 10.5% EBIT margin seems reasonable. By the way, if you look at the 2001 recession, it doesn't seem to have very much of an impact. So this is not a very cyclical business. So I take the 10.5%, I multiply by the 4.633 billion in sales, because it's these margins are overall sales. I get about a $480 to $490 million earnings power. The average tax rate has been 36, 36, 35. I just took 35.5. You could take 35. It's not going to make a huge difference. So at 35.5, taxes are 173. You get a net earnings power of about 310 to 315 billion. If you want to be ridiculously precise, you got a number 313, but you ought to be aware that that's an estimate in a range. Then I do want to do a depreciation adjustment. I have depreciation and amortization. Where do I get that number from? Cash statement of cash flows, 115 million. If anybody disagrees with these numbers, you ought to shout it out. I get investment from the statement of cash flows. It was 134 million. Obviously, some of that investment is funding growth, and I want to take that part of the investment out. The change in sales was quite sharp between 2003. The difference was 391 million. On the other hand, this is not a particularly capital-intensive business. You have end-of-the-year PP&E of 475 million on a depreciated basis over 4.6 billion in sales. It's about 10 cents of physical capital per dollar of sales. And when you remember that they're outsourcing almost all of their production to China, that ought not to be a big surprise. Yes? I could be careful about that at lower growth investment, but you're going to see what happens if I do that. Hold that thought, because that's a good. I did that second and then decided. You'll see what I'm going to do. If I do it this way, though, I get a growth CapEx of about 40 million. I get a maintenance CapEx of 94 million, which is the difference between the 40 million growth CapEx and the total CapEx. How does you as maintenance CapEx, given in the depreciation numbers? It seems actually pretty high, if anything. It's a lot of, that's, given that these are just offices and buildings in North Bergen, New Jersey, and the Meadowlands that they're not going to invest in, that they've got some warehouse equipment, they've got some trucks. That's a lot of money, I thought. So I thought, if anything, I was overestimating maintenance CapEx. Again, if you have any doubts, call an expert in the industry or talk to the company. Many companies, by the way, divide CapEx into maintenance CapEx and growth-oriented CapEx just on their own. You could do your adjustment, but you know how it's going to affect this, right? It's going to put that maintenance CapEx up. And, you know, if I've got a balance sheet value of like $475 million for CapEx and I say maintenance CapEx is $94 million, it's as if I'm replacing that entire amount every 5 years. So I think that's a high number. So I'm going to leave it where it is. I'm not going to do your adjustment, which, to be careful, I should, because I think the numbers are going to look more realistic this way. I have $94 million in maintenance CapEx. That means that the excess depreciation is about $21 million. Again, for the moment, that $21 million is completely tax protected, so it's completely distributable. If I reduce my CapEx by that amount and depreciation goes down to mirror that, then sooner or later that $21 million excess depreciation is going to be fully taxable because I'm going to lose the depreciation. So I go from a tax rate of 35 today to 0 at some point, so I applied a tax rate to that of half 35.5, which is close to 0.18, which is about $4 million in tax. It's not a big adjustment anyway. So I'm adding back about $17 million in over depreciation. The number is not going to be far from that. If you guys did this carefully and came up with an extra $20 million, I wouldn't be shocked. If you came up with $10 million less because of the things you're talking about, I would equally not be especially shocked. But let's work with 33 million and see the story that tells about the earnings power value of this company. Well, I've got to get a whack. And here there's a big theoretical issue. Theoretical issue is, do you use the whack that you think the company should have, or do you use the whack that you think the company is actually going to have? And as an investor, what determines how you should do that? If you think you or somebody else is going to take over the company and recap, looking at the private equity value of this company because you think it's in the sights of private equity firms, then you're probably going to use a relatively high debt level that for a company as stable as this is appropriate. If you think you're going to be left, and that's going to give you a lower cost of capital. If you think you're going to be left with the present management in place, then you pretty much got to use the current debt level, which is about 12%. Now, I'm willing to do this both ways. Mostly, people give me a hard time if I use the theoretical. Here, is there any buzz about Liz Clairborne being taken out by a private equity or some other firm that's going to change behavior? I don't think so. So here it's probably also justified. Did anybody do this with like a 50% fraction of debt or a 35% fraction of debt? It's certainly defending the company in the expectation that it may be taken over. Anyway, so with 12% debt at a 7% cost of debt and a 35.5% tax rate, the cost of that 12% of the debt is 0.5% a year, a little over, 88% equity. Where do I get the 9% from? I'm assuming this, despite being in the rag trade, this is a reasonably safe investment. So in the spectrum between 7%, which is the cost of debt, and 15%, which is the cost of venture capital equity, I think this is probably going to be much closer to the 7% cost of debt. So I picked 9. What do you want to ask yourself? Wouldn't an investor, an equity investor, be satisfied with a 9% return on investment in this company? Well, what do you think the return on the market is these days? It's about 7, realistically, at most. So a 9% return here is probably pretty reasonable. Yes, sorry, Daniel. Well, but if I bought it and actually, is that a good point? Hold that point, because I want to come back to it. I could be. But think about what would happen if the cost of capital went way up. What would happen to the earnings power value? It would go down. But if the asset value was still there, what would happen to the prices it could charge? Again, it could raise its earnings without attracting people into the business. So hold that thought till we do the comparison of the earnings power value and the asset value, okay? If I saw an earnings power value on using this cost of capital that was way above the asset value, then I'd really have to worry about that. But if they're approximately the same, think about what you think might be appropriate, because there will be countervailing movements in the earnings that compensate for the change in the cost of capital. So I get about an 8.5% WACC. I've got 330 million in earnings power. I divided it shouldn't be by 0.85, it should be by 0.085. It gives me a value of the operating business of about 3.9 billion. I've got about 450 million in excess cash. And remember, is the value of the ongoing business plus the value of any assets that you could strip out. So if you thought you could strip out real estate, because actually if you've been in their buildings, there are huge empty areas. In North Bergen, they used to run factory machines of various sorts there. Then you might add something else for the real estate. But again, you'd want to do that carefully. But here you get an earnings power value of about 4.4 billion, 4.35, and an asset value of about 4.5 billion. I'm about 1% of sales, so that's already embedded in the earnings power value. You couldn't strip out that 47 million and distribute it. So it looks like I'm getting an average value somewhere around 4.4 billion. Yes, sorry, Joe. Because I always want to evaluate things on an enterprise value first. Okay? And then, if I want to know the equity value, I just subtract the value of the 540 million debt. Remember, when I did the net assets, I didn't include the debt as part of the liabilities. I think you always want to start with an enterprise value basis, because a lot of times you're going to find little stubs of it, like the equity is trading at maybe only a third of its value. But the enterprise as a whole may be trading, if there's a lot of debt, at 85 to 95% of its value. So even though on an equity basis it looks like you're buying a real value, on an enterprise basis you're not, and the enterprise basis is probably what's appropriate. Yes? That is a very good question. Should I do that? And think about how they're growing. This is where, I'm sorry, I keep forgetting your name. I should remember it, right? Steve, of course. Steve, what do you have to say about that? They are growing by acquiring brands and by raising prices, just with the rate of inflation. Because don't forget, inflation is like 2.5% here. So when you start subtracting the buying of the brands, do you think that their advertising and other SG&A is actually building equity in those brands, or is it just replacing depreciation in the equity? To the extent that the SG&A, the advertising, and the sales expense is just sustaining the brands, do you want to add it back? Yes, exactly. Exactly. And that seems to be reasonable here, since they do seem to be buying these brands. And when you talk to people about the Liz Clairborne brands, there seems to be a balance between the dying ones and the new ones that are growing. if you were right, then what you'd see is rapidly growing revenue and rapidly growing profit with that revenue. Okay? All right, what's the next question you want to ask here? Is there a franchise here? Because that's going to establish how reasonable the approximate equality between the earnings power value and the asset value is. Well, how do you think of franchises? You could look at the long-term returns in the industry. You could look at entry and exit. You could look at share stability. Is there a lot of entry and exit into this industry? Yes. Is there a lot of share stability? Well, they maintain it by buying brands, but of the old brands, not a lot. Are there long-term brands that remain dominant forever? Well, there are some stable brands, but by and large, this is nothing like Microsoft or Intel. In terms of by the way, the average return in the rag trade, does it look like they're earning excess returns on the reproduction value of their capital? No, because the earnings power value is actually below the reproduction value of the assets if we calculated it. So it also looks like in this case, there's not a lot of excess return. And this is a relatively profitable company. Ask the basic questions that we talked about last time. You think there's a lot of customer captivity here? Not really. Are there big economies of scale? Do you have to be big to survive in the fashion business? No. Are there proprietary technologies here? No. So guys is here on big barriers to entry. If you decided to get into this business, do you think it would be tough? Do you think it would be as hard as getting into the cola business? Well, if there's no franchise, then the story that's being told by these numbers, what is this comparison's franchise value? There isn't any. So do you start to have more confidence in both these numbers? If I asked you, what is Liz Clairborne worth, what would you be inclined to say? About $4.4 billion? Is there any doubt about that? I mean, that's probably a pretty good estimate, and it's not based on Excel projections or multiple analysis, because if you actually look at the various firms in these industries, the multiples are all over the lot. And Tommy Hilfiger is up, it's down, it's up, it's down. Jones New York is up and down. Even Liz Clairborne itself has substantial fluctuations. So you ought to have a sense after all this that Liz Clairborne is probably worth about $4.4 billion. Yes, Anthony. Right. Right.
Couldn't you argue that there is, there is some limited customer activity? Because they're not promoting the Liz Clairborne brand, right? They're going out and looking if you can acquire this.
But if there is potential customer activity, who makes the money from it? Is that part of the price that they pay for the brands?
Perhaps.
I mean, how do you think the market is for these brands? Do you think that they just...
It's probably competitive when they go.
Well, I mean, think about how it works. You own Lucky, and you decide you want to sell out. What's the first thing you do?
Try to value your own brand.
That's not the first thing you do. Go ahead, yes.
I was going to say, the valuations seem almost reversed. It's striking that the Lucky brand is marketing to the younger folks.
Right.
Probably tend to be a little bit more fickle, so they're less...
They probably are, but just in terms of any of these brands, if there is customer captivity associated.
But I'm saying, if there's customer captivity in any of the brands, it would probably be for the ones that are targeting the older people.
The older
yet you're
people,
paying a lower multiple to sales, so it really doesn't sort of make sense.
What I want to respond to that, because I don't have a good answer to that. Right. And what are they, when in the, are you going to make money usually in acquisitions? Somebody actually done a deal like this? Do we have an investment banker in the room? Anthony, you never want to buy anything from an investment banker, but you always want to sell through one. So what's the first thing you're going to do if you're Lucky Brand Jeans? Hire an investment banker. And what's the first thing that investment banker is going to do? Well, he's going to go to every potential purchaser and try and pitch that brand to every one of those purchasers. So if you wind up buying the brand, what kind of price are you typically paying? You're paying full price for what. If you're going to make money from the purchase of this brand, what have you got to be able to do relative to the ability of the other people who might have bought it? Well, there are probably not a lot of synergies here. You've got to have the management that's better at making them. And you will see in the history of the valuations, because we've been valuing this company since 1997, that there is some evidence that Liz Clairborne is capable of doing that. But over the long run, it doesn't look like they make much value. And I'll show you, if you want, I can show you that numbers. What I want to do, though, is stop here and ask people if they have a good sense of what this is worth and whether there are any really big uncertainties about this one. Are there any questions that you have? Did anybody get something very different from between 4 and 5 billion? Yeah, go ahead. Right. Why is their reported return on equity higher? What's missing? Is the true value of equity in the denominator there? What is the history of a company like Liz Clairborne typically? Do you know what their returns on equity looked like in the early days? They looked enormous. And they were they're about 50, right? Does that reflect the true reproduction value of the equity? Look, let me just... right, but look. But look, I have earnings. And I divide those earnings by the value of what I have to tie up in the business to get those earnings, right? So it's the value of the net assets. This is because we're talking about equity after subtracting the debt. So the equity value here would be this 4.4 billion minus the 540 million in debt. What number do you want to use for the value of the net assets? No, I don't want to know. I want to know, we're going to calculate what their real return on equity is. We're going to do that. Should I include the value of the intangibles or not? Should I include here? Yes, of course I should. And when I do that, what's the value of the assets? Didn't we estimate the reproduction value of the assets? It could be wrong. But hold on just a second. Don't go away. I'm not going to shut you down. I'm going to try and humiliate you, but I'm not going to shut you down. I think are the real distributable earnings here. 330. Really necessary to generate those earnings. Are they? No, I could strip out a bunch of excess cash of about 450 million. So I'm going to divide the actual value of the assets in the business by the 330 in earnings. Because notice this 330 didn't include the interest on that 450 in cash. When I do that, what does that number come very close to? No. It better come very close to 8.5%. What was the WACC in this case? Right. So am I really earning an excess return on equity here? Why? Okay. Right.
And if you look at some of the brands they bought, they usually overpay.
Well, we're going to look at that in a second, but go ahead.
So if you go with the theory that they overpaid over time for the brand, that they're buying brands just to run ahead. They have a dying brand.
By the way, for what it's worth, you will see you've made an assertion that's probably false, that they are actually quite good at creating value from these brands, and you'll see that. But keep going.
They don't give you the earnings.
Suppose that what you're saying is false, so that they haven't overpaid for the brands. Is the return on equity is the return on capital about the 8.5% WACC?
If they haven't overpaid, yes.
Okay, so it's that they have overpaid, there may be a
If
problem.
they have overpaid, then that cost of goodwill recorded might be about right.
It could be. It's true.
And then the high return on equity will justify itself.
Well, I mean, it means the book value captures the value of the brands more or less properly. But of their brands, did they buy them all? No, I know. But what's the history of this company? John, let's talk about the history of the company. No, out of how much?
4 billion.
Yeah. No, it hasn't been every year. But, John, did you look at the full history of this? Before 1990, they don't buy many brands. They buy Dana Buckman a long time ago. But what is the history of this company? Do you know? In its early days, what do you think their reported returns on equity were?
30%.
Yes, exactly. They're 30%, 25%. And then actually at the sort of the beginning of the period where we've got the record, they get in real financial trouble. Where did a lot of the equity in this company come from? Good luck. What happened is they, like everybody else, opened a rag trade company. They put equity into it and they put sweat equity into it. What happens to most of those rag trade companies, John? No, I got it. What happens to most of those rag trade companies? They go out of business. What happens to their equity? It disappears. But it's still equity invested in the business in some sense. What happens when you're really successful? You make big money. But on average, is it pay to get into the rag trade, do you think?
No.
So lucky people generate a lot of ostensibly free goodwill or brand equity and earnings. But can you count on doing that as a rule?
No, but they are doing that.
Well, no, they're not. You'll see in a second. We'll deal with but so historically, the reason why the book value of the equity is low relative to these earnings is that a large part of this extra brand equity consisted of the historical good luck that they had. Some of it also consisted of good management. I want to show you the history of our estimates of what is going on here. The first time we did it, the first time we valued this company, we got an asset value actually that was above 2 billion, but we had an earnings power value of a little below 2 billion. We actually valued the assets incorrectly, but it was about a $2 billion value. The price in which the company was trading in the market was $1,650,000,000. Now, you got to be careful here. The price should go up over time, even if there are no excess returns. Why? Because it only pays a 1% or 0.6% dividend, so you should be getting the rest of the money from money reinvested in the business. And if you think in those days the WACC was about 10, it should be growing at about 9% a year. If you look at that, the target price and the target value by 1999 should be about 2.4 billion, right? This is what happened. Our estimate of the value was about 2.5 billion, and the price was 2.4 billion. Did it look like between 1965 and 1997 and 1999 that they destroyed or created value? Well, listen, you think 4.5 is distinguished, 2.5 is distinguishable from 2.4? No, they're probably right on target then. They're probably right on target then. And notice the price converges very close to the value at that point. It was undervalued. It turned out to be close to full value 2 years later. And it was not a bad investment, although it was not as compelling an investment as it had been just a few months before when it was trading at about $1 billion. And it really jumped up from that. This is what happened by 2003. The number on the right is sort of what the return should have been, what the value should have been given the reinvestment of earnings. It should have been about $3.4 billion. When you actually looked on the balance sheet at what they'd made of those brands, and you look at the earnings power that they derived from the brands, the number was actually about $4.5 billion. And that was the earnings power. And interestingly enough, the market value was up there with the $4.5 billion. What does that suggest that they've done with these brands that they've bought? Have they created or destroyed value? They've created value. And they have a terrific reputation, by the way, in the industry. On the other hand, are they always good? This is what happened the last time we did it, which was as of 2004. It looked like the value had gone down a little, although the market price had gone up. That's the $4.4 billion that you've got here. They didn't do quite as well in earnings, but they were still ahead of where the target would have had them. Although the reinvested capital, because the WACC is down, is only 7.1 now. This is where they are at the end as we speak today. I mean, I haven't done the value off the balance sheet, but look where the market value of this company is. And look where it should have been if they were just recovering the reinvested earnings. What does this story tell you about the ability of this technique to identify value? It's not bad over the long run. That this company has always been more or less fairly valued. There's a period where the management actually does a terrific job buying and promoting the brands. But sooner or later, it comes back towards the mean. When it reinvested the profits of that brand building, it didn't necessarily do so well. So, John, the thing is, you can make assertions like that, but you can actually check them over time.
Remember last week when we said there's no synergy if a car company buys a washing machine.
Yeah.
Because they can't make it at the same time.
Right.
And our business is to make those 38 grand per item, depending on
Right, sure.
make a t-shirt in the same plant for all 38 grand.
But do you think they manufacture, John, any of this stuff?
No, but they outsource.
Yeah, of course.
And
So there are no synergies there.
but they get big synergies in ordering big quantities.
No, it turns out they don't. That is another myth. I mean, the trouble, I'll tell you how I know that. We are big investors in a catalog company that sells furniture, and it's all made in China. And we keep expecting to see the purchasing power go up and your ability to get better bargains. Now, I'll tell you why. The guy who runs this company buys stuff from India and China. And there's an Indian village where he buys just $1.5 million worth from the plant that employs the whole village. No, this is for the catalog company that sells. These are rugs they make. When he goes to that village, they treat him like a god. $1.5 million worth of sales to them is an enormous amount. And they will give him not only a discount, they'll give him any human being in that building he wants to commit to a human sacrifice for that. So I don't think you have to have very big scale in these markets to get low prices. That's, all the evidence is, again, not. Right.
Certain point, you can't get any more synergies, but risk is a high.
How high is it? These guys, how big are these guys relative to the average guy?
These guys, they can push on prices.
Right, but Jones, New York can do the same thing. That's presumably why it's these guys who are buying these brands. But listen, John, you can't have it both ways. You can't tell me first that they were overpaying and screwing everybody, and now tell me there are enormous synergies. And that's all that's going on here, which is why they did so well. You got to do this one way or another,
But isn't
right?
it the same story? They're overpaying because they have the synergies that Juicy.
No, but that's no.
have.
They win the auction because they have the synergies. The evidence that they're overpaying is not there. They seem to be creating the value. But you can't at once say they paid too much, and then they made a ton of money on the purchase anyway because they had all the synergies. Because that second statement means they didn't pay too much, and the first statement made they did pay too much. There's an important point here before I let you all go loose and destroy your brain cells. Information about an industry is extremely valuable, but you have to put it in a context controlled by systematic attention to the data. Or you'll tell yourselves a lot of stories where you say London buy, then you say San Francisco sell, and then you say London, San Francisco is selling sell. You're going to be buying and selling to yourself unless you're careful on how you use the information. This is a second example. What we'll talk about next time is risk management and valuing growth in this context. And then you'll do a couple more evaluations, and then you'll get to do the stars of this world.